The CRA has new rules for how you calculate SR&ED. We built a calculator so you can quickly figure out how much of the $500 million of new money you qualify for. To start using the calculator, head over to GrowWise.ai, click on Tools, and then the 2025 SR&ED Comparison Calculator. Let's scroll down a little bit. Now remember, this calculator is only comparing the federal tax credits and the difference between the new rules and the old rules. So let's put in some numbers here. Let's put in, say, $1 million of SR&ED eligible salaries. We see here that there's basically no improvement between the old rules and the new rules for a Canadian-controlled private corporation. If I add a few materials here, let's say they spent $50,000 on materials, again, there's no difference. And even if I add some contractors, maybe $200,000 worth of contractor expenses, while it's calculating the federal refund accurately, there's still no difference between the old rules and the new rules. However, if you might have some capital expenses, such as equipment that is used for the purposes of experimentation, so it needs to be at least 90% used for SR&ED, then you could add that here, and let's see what happens if we do that. So let's say you had $100,000 worth of depreciating equipment that was used. We see here that in the old rules, they were not eligible, but the new rules, you get a nice big benefit, and it's a $35,000 increase in your federal tax credit, which is a 5.7% increase in this particular circumstance. Now, obviously, the percentage increase would be greater if you only had $300,000 of eligible salaries. It would have a larger percentage increase, but it's still $35,000 due to the capital expenditures. There are three big changes the CRA has made. The first change is an ECPC, or an eligible Canadian public corporation. These are companies that are listed on a stock exchange in Canada that have more than a 50% Canadian ownership. These now qualify for special rules when it comes to SR&ED, including the enhanced tax credit and refundability. With an ECPC, or an eligible Canadian public corporation, the rules have changed dramatically. Let's input maybe $1 million worth of SR&ED eligible salaries. We see here for the old rules, so the pre-December 15th, 2024 fiscal year start rules, that it was a non-refundable tax credit of 15%. And so you ended up with $232,500 for $1 million worth of SR&ED eligible salaries. However, in the new rules, it is significantly different. First of all, it's refundable tax credit. Second of all, it is the enhanced tax credit of 35%. And therefore, the total improvement is $310,000, or 133% improvement over the prior year. Now, if I input materials, I'm also going to get a benefit. Same with contractors, I'll get another benefit. Another massive change is that capital can be claimed as a SR&ED expenditure. This is huge for manufacturing companies, or for biotech companies, or for any company that has large capital expenses. You see here that I'm continuing to accrue additional tax credits as my expenses are increasing. Additionally, if I add capital expenditures, say $500,000 of capital expenditures, they simply didn't qualify under the old rules. But in their new rules, they do qualify. So as a result, I have almost a 200% increase in my SR&ED claim. And once again, that is all refundable now, which is absolutely fantastic for ECPCs. Another very significant change is the expenditure limit is increasing from $3 million to $6 million. This means that you would receive the enhanced tax credit to $6 million worth of expenses that qualify for SR&ED. There is a grind, and that grind depends on if you're an ECPC or a CCPC, and it depends on either your prior year taxable capital or your prior 3 years average income. Those numbers have changed slightly also, and the calculator accurately determines the exact SR&ED claim that you would have. Let's look at an ECPC phase out, which basically means that as the average gross revenue goes up, the $6 million expenditure limit is decreasing. So it's easier to look at this when you have a very large SR&ED expenditure. So if the average gross revenue is $15 million or below, really not much changes. However, if the average gross revenue goes up to, say, $25 million or $75 million, at the $75 million mark, the non-refundable portion is 100% of the SR&ED claim. There is no refundable portion. And therefore, there is a grind from $15 million to $75 million for ECPCs based on their average gross revenue from the last 3 years. The calculator will calculate everything very accurately. So just put in the numbers that you have, and you'll see exactly the difference between the old rules and the new rules based on all of the numbers that you provide. Just want to do a deep dive on the phase-out rules for CCPCs. So let's put in $10 million of SR&ED eligible salaries. I know it's a big number, but we're going to look at more specifically the phase-out rules here. We see a total of $2.9 million of SR&ED eligible ITCs compared to 3.5 in the new rules. So let's look what happens at the taxable capital phase out under the old rules. And let's put in a big number here of $100 million. What this means is that at $100 million for a CCPC, we have the non-refundable portion increasing. That is similar for the new calculations. However, you can select in the new calculation to use your average revenue over the last 3 years. So let's say that the average revenue for the last 3 years has been $20 million per year. What we see happening is that because I've selected to use the gross revenue, that the non-refundable portion is decreasing compared to the prior rules, and my total refund is increasing. So therefore, if your gross revenue over the last 3 years is less than your taxable capital for the SR&ED rules, it's better to use that, and you now have that option in the new 2025 rules. What if I want to find out the exact SR&ED claim that I have based on my province and everything else that is going on in my business? Well, then just head over to Tools and SR&ED Calculator, and this provides you the most accurate SR&ED calculation on the market for CCPCs, ECPCs, and public corporations. There's some optional information you could enter, like government grants or assistance, or the prior year taxable income, or prior year taxable capital, which will grind down your expenditure limit. From there, you will see a fully detailed list of how much you would receive both provincially and federally. So why don't we just do a very simple example here. We'll put in just a few salaries, and we'll put in that we have a fiscal year start date of January the 1st. We see here that in Ontario, there is a refundable portion of the claim, a non-refundable portion of a claim, the federal portion of the claim, for a total of $658,000 of SR&ED refund for $1 million of SR&ED eligible salaries. And here it shows you a nice graph of how that would compare between the pre-2025 and the post-2025 rules for SR&ED. So if I went up and I put in other things like capital, there we go, $500,000 of capital. It shows you at the current 2025 rules, you would get a much more significant increase than the pre-2025 rules. If you have any questions about the new 2025 SR&ED rules, using the SR&ED calculator, or anything about SR&ED, please feel free to reach out to us.